On Friday, the London Metal Exchange introduced a new ESG-based contract framework for silver. At first glance, it sounded like another boring compliance update. But under the surface, this move may completely reshape how physical silver flows through global markets. And timing matters. Silver is already sitting just below a major breakout zone while institutional positioning is quietly shifting in the background. That combination is what has smart money paying attention right now. Welcome back to Finance Rafe, where we focus on the market mechanics hiding underneath the headlines. Because while retail traders were staring at daily candles, the real story was unfolding inside vault inventories, delivery systems, and institutional supply channels. And if you own silver, trade metals, or even follow macro markets casually, this is something you need to understand. Let's break down what actually changed. For decades, COMEX has dominated silver futures trading. But COMEX is mostly paper-based. The majority of contracts never result in real metal changing hands. Most are settled in cash. The LME operates differently. It's far more connected to physical settlement and institutional metal movement. Large funds, sovereign entities, and industrial buyers often prefer the LME system because it provides more direct access to actual stored silver. That distinction suddenly became very important. The new LME framework introduced three major changes at once. First, the exchange tightened purity standards. Silver settling against certain contracts now requires a higher purity threshold. That sounds minor, but it changes which inventory can qualify for delivery without additional refining. And refining means delays, costs, and bottlenecks. Second, the LME expanded approved vault access into regions like Singapore, Hong Kong, and Dubai. That's the part almost nobody is discussing. Until now, most official settlement activity flowed through a relatively small group of Western vault networks. By opening new channels in Asia and the Middle East, the LME effectively created alternative supply pathways outside the traditional system. That matters because large amounts of silver inventory already exist in those regions, much of it sitting outside public exchange visibility. Third, the exchange added sustainability verification requirements. On paper, this is about ESG compliance and sourcing transparency. But structurally, it creates friction. Not every silver producer or vault network can instantly provide clean certification trails. That means some inventory becomes harder to move through official settlement channels. So the market suddenly faces a strange situation. New vault access increases flexibility, while stricter standards reduce immediately deliverable supply. That tension is where things get interesting. Because behind the scenes, another trend has already been developing. Over recent months, physical silver inventories inside COMEX vaults have been slowly tightening while paper leverage remained elevated. In simple terms, more claims were building on top of a shrinking pool of available metal. That imbalance doesn't always matter immediately. But when exchanges begin changing delivery structures during an already tight setup, institutional traders start repositioning very quickly. And some signs suggest that repositioning may have already started. Recently, large inflows of physical silver suddenly appeared inside exchange storage after months of steady declines. To most traders, price action looked boring. But underneath the surface, inventory behavior was changing. That's usually where major moves begin. Now combine that with silver's technical setup. For months, silver has been trapped inside a tight consolidation range. Every rally failed near resistance while every dip kept finding support. That kind of compression rarely lasts forever. Markets typically explode at a prolonged ranges once a structural catalyst appears. And this new LME framework may be exactly that catalyst. The key level many traders are watching sits around the major breakout zone near recent resistance. If silver decisively pushes through that region, momentum systems, algorithmic models, and institutional positioning could begin aligning in the same direction simultaneously. That's when moves can accelerate very fast. But there's another layer most people ignore: lease rates. Lease rates measure the cost of borrowing physical silver. When supply feels abundant, lease rates stay low. When traders become desperate for real metal, lease rates spike. That's one of the cleanest signals of stress in the physical market. If those rates begin rising sharply over the next couple of weeks, it could confirm that institutions are actively scrambling for deliverable silver, not just trading paper contracts. And that's important because short positioning in silver remains elevated. If physical tightness increases while prices begin breaking higher, some short sellers may be forced to cover. That creates additional buying pressure. And once short covering starts feeding momentum buying, moves can become violent. Still, there are risks. A stronger US dollar could slow the breakout. Macro pressure could delay institutional flows. And there's always the possibility that the market simply absorbs the rule changes without major disruption. That's why confirmation matters. If silver fails to hold support levels, if inventories suddenly surge higher, or if lease rates remain weak, then the bullish structural thesis weakens significantly. Professional traders don't marry narratives. They follow data. Right now, the data suggests something important may be shifting beneath the surface of the silver market. Not guaranteed, but increasingly difficult to ignore. And historically, the biggest opportunities appear when structural changes become visible before the crowd fully understands them. That's exactly the kind of moment silver may be entering now. So here's the real question. Is this just another temporary rule adjustment, or the beginning of a much larger repricing event in the silver market? Because if institutional money has already started repositioning, the window before the broader market notices could close very quickly. Subscribe to Finance Rafe for more deep market breakdowns. We don't chase headlines. We track the structural shifts that move markets before the crowd sees them.